Good evening, this is Rodney with the Triton Wave Market Outlook for Monday, February 11th, 2013. Okay, I want to start off by looking at the S&P futures. And obviously it gapped up on the first of January or January 2nd, and it's just taken off. So one of the things I wanted to show you was this line of tops here, and we are right basically at the 1272. Now the 1272 is 1499. I actually thought it was going to top out at 1507. It's now 1513, so it's 6 points above that. Getting very, very toppy. You can see from this beginning trading wave on T1 that the direction of this wave is falling off. And if we go to the 21 period moving average, then you can see that, let's get rid of this here. You can see that these are nice above zero, below zero, above zero, below zero, and it's almost ready for this to come back down a little bit. In concert with that, I don't have the graph with me right now, but in concert with that is a severe sell-off in the Japanese yen, and that needs a bounce back, which would take the S&Ps down and the whole market down, and the US dollar is about to make a turn up. But first I want to give you a little bit of history of what's been going on with not politically but economically since 1931. During the midst of the depression, worldwide depression in the 30s after the stock market crash, and I won't even get into why that all happened. But obviously everyone was in a fight to have their goods recognized as export with export advantage over the next guy. But they couldn't do that because everybody was in a state of depression, one worse than the next. So what happened was that in 1931, Great Britain disconnected itself from the gold standard. It was the first country to do that. So what happened was that, let me get okay, so what happened was that the Great Britain pound, okay, don't pay attention to this graph here. Actually, let me do this. I'll start with a blank screen here and just draw pictures. So the Great Britain, the pound went down, and as a result, their exports went up. Okay, in 1931, Great Britain did it. Japan disconnected itself from the standardization of gold standard. In Great Britain, Japan, and all of Scandinavia. So all of Scandinavia, all of Great Britain, all of Japan look like this, and their exports started going up. Okay, later on, Italy did the same thing, 1930, 1932. United States did it in 1933. France, Poland, Belgium, and Switzerland all did it in 1935 to 1936. They realized that they were being left behind as far as exports were going. So what exactly does all this mean? There is it turns out, historically, there was a very almost linear progression, or there's a linear relationship between the severity of one's depression, of a country's depression, when they disconnected from the gold standard, and the length of their own recovery. So the earlier that, and it turns out that Great Britain, Japan, and all of Scandinavia came out of the depression more quickly by devaluing their currency and letting it float, by disconnecting from the gold standard, so that their the exports were cheaper to other countries and more people bought them. So it turns out that the earlier these countries disconnected from the gold standard, the quicker their recovery was. And that's what history has proven. Okay, so that brings us to, since we're off the gold standard, that brings us to modern day. Today, last 5 years, when QE1 was used as a stimulus to lower the in effect, it lowered the value of the dollar, and the dollar started dropping. Then QE2 came along and did the same thing. Then QE3 came along. All right, back in September, when the first major announcement of QE3 came in, we were looking at this area right in here. So first it was Ben Bernanke came in here, obviously moved the market, and then Mario Draghi came in here, that moved the market with the ECU, and then Japan tried it, but they were a little late, and China tried it, and it really didn't. Everybody was getting wind that nice try, but it's not going to work. You know, like once fooled is enough, and it brought the market down on the S&Ps from 1454 down to 13, you know, like 100 points or 1,000 Dow points. Okay, so now we have even more. We've got a QE 2.5, QE 4, I don't know, whatever you want to call it, when Bernanke comes in and says, okay, we are going to buy an additional $45 billion worth, and the market just takes off like a rocket. And now he's saying that it's endless. So what is this doing? Basically, what I called this at the time was the Bendragi crown. Anyway, so the net result is that if you try to decimate your own currency, then your exports look really good to somebody else. So we started doing it. The ECU started doing it. Japan was doing it, and China, and basically the 4 biggest players in the world. So it's a race to see whose exports are going to be more appealing to everybody else in terms of dollar exchanges. The problem is it's kind of like a race to the bottom, because we're at almost zero interest rates in every major country in their central banks, and to me, it's a really, really tenuous situation that could just explode in everybody's face, because you can't keep devaluing your currency, because it kind of like it starts feeding on itself, and then you have nothing to come. You can't say, okay, we're going to do it any lower, because it's already like 1/4 of 1% or 1/8 of 1%, especially in Japan and the United States. So instead of the worry of inflation that's coming out, there is a real threat of deflation. So this was brought to light by Brazil's finance minister in 2010, Guido Mantega, came out and made a public statement saying that we are in an international currency war. Now everybody else kind of like tacitly knew that, but they wouldn't say it publicly because they didn't want everybody to know what they were doing behind the scenes. But that's basically what it is, an international currency war, and it could get really, really ugly very quickly. I want you to keep this in mind, as some of you just take opportunities to buy the S&P or the entire market when there are only like 10 major stocks that are moving the market, and the rest of it's moving either basically sideways or up a little bit. But it's 10 major stocks that are carrying the market, and they're all the big names. You know the big names. So it's riding this crest of the 8-period exponential moving average. Any bad news will be recognition that fear can come back into this market in a heartbeat, and you will see a 100 to 200 point move in the S&Ps. Just be very, very aware of it. The cycle timing for something like this to happen is absolutely imminent. And I'm telling you, on this day, on February 10th, on a Sunday, 2013. Good luck trading, and I'll see you at the next update. Okay, for those of you who don't know, you can pause this and look at it. I have a Triton Wave consulting service that is, I will do videos just like I did tonight, but tailored to your individual needs with any kind of stocks that you have or markets that you want to follow. And this is the fee schedule. You can pause that and take a look at it. And you can send me an email at tritonwaveguy@gmail.com. And I have one more thing to show you here. And I just wanted to point out to you, for those of you who have not seen this before, that National Association of Day Traders has called my work, the Triton Waves, a major new trading tool, and you can reach me for private consultations. Again, at tritonwaveguy@gmail.com. Have a great trading day, and I will see you at the next update.